Is MongoDB a buy or a sell? Let's get started with the model. This is a large cap company, 26 billion market cap. They're trading at $3.50 a share, and they have 74 million shares outstanding. MongoDB is a document database used to build scalable internet applications. It is very popular with development teams. The company was formerly known as Tengen and changed its name to MongoDB in 2013, incorporated in 2007, headquartered in New York City. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They only had $50 million of free cash flow in 2022, $60 million in 2023, then a small negative in 2024. Now it's the highest ever, $149 million in the trailing 12 months. Really low margins. They only convert 8% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that is negative every single year. Revenue is a sales for the company. That looks pretty good, from $900 million to $1.8 billion. It doubled in about 2 years. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows. Past year 4, that's $17 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $14 billion. We divide that by 74 million shares. And we get a calculated stock price of $189. They're trading at $3.50, so they're trading at an 85% premium. It's a sell according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 105 companies in the same industry as MDB, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, only $6 million. A decent debt-to-equity ratio, 0.9, which is better than the average. For every dollar of equity, 90 cents of debt. They don't pay a dividend. They generate $149 million of free cash flow, a little more than the median. They rank 11th in market cap at $26 billion. They do look overvalued according to their price multiples, trading at 17 times book value. We can't look at their PE. They have negative earnings, 174 times free cash flow, and 14 times revenue. Their price of sales is a little worse than the average. Akamai has the best price of sales, 3.6. That's a really good company. And their revenue is growing a lot. Their 5-year annual revenue growth rate is 39%. They're trading in between their 52-week low and 52-week high. And their 50-day moving average is below their 200-day moving average. When the 50 crosses below, that's a death cross. That's a bearish signal. If you put $10,000 into this company when they started trading, you'd be really happy at $114,000 today. A 1,000% total return, a 40% annual return. So to summarize, I have them trading at an 85% premium. They seem really overvalued, so I'll give them a ranking of 4 out of 10. I probably wouldn't buy it short term, 3 out of 10. I might buy it long term, 5 out of 10. Really weak ratios, 2 out of 10. A lot worse than the median. Financials look pretty good, 7 out of 10. Free cash flow up 187% since 2022. Revenue up 108% since 2022. Let's look at their 10Q. Here's their income statement. The 3 months ending 7/31/23, the 3 months ending 7/31/2024. A pretty good revenue growth from $420 million to $480 million, about 18%, I think. Subscriptions is where their growth is. It went from $409 million to $464 million. It went down in services. Let's see if they give a different breakdown of the revenue. Of the $480 million of revenue, $280 million in the Americas, $136 million in EMEA, and $56 million in APAC. It did go down slightly in APAC, up in the other 2 regions. Mongo Atlas is their biggest revenue generator, $340 million. Other subscriptions went down. Thank God they have MongoDB Atlas, or they'd be screwed. Let's go back to the income statement. Below revenue is cost of revenue. For subscriptions, it's $107 million. That's based off of $460 million of revenue. In services, expenses are higher. Expenses of $21 million, revenue of $14 million. So they're losing money in services. Total cost of revenue, $128 million. Gross profit, $349 million, up from $318 million. Then you have operating expenses, sales and marketing, $220 million, R&D, $148 million, and also G&A, $51 million. Operating expenses are higher than gross profit, so they have an operating loss of $71 million. Last year, a loss of $49 million. They do receive $24 million of interest income. That's interest on their investments. They pay $2.3 million of interest on their debt. So their pre-tax loss is $51 million. They pay $4 million of taxes, so a net loss of $55 million, which is worse than last year of $38 million. They're also adding shares. Last year, $71 million, now $73.5 million. Let's look at a balance sheet. $2.7 billion of current assets, $500 million of current liabilities, a really high current ratio, above 5. They have $2.3 billion of cash and short-term investments, so they're well funded. Total assets, $3.1 billion. Total liabilities, $1.8 billion. Their biggest liability is convertible senior notes, $1.1 billion. The company hopes the stock price goes up a lot, so the debt converts to equity and they don't have to pay back the $1.1 billion. Of course, if the stock price doesn't go up, they will have to pay it back. Assets minus liabilities equals equity, $1.4 billion of equity. They raised $3.2 billion from selling their business. They lost $1.8 billion from running their business. Let's look at a statement of cash flows. This is for the trailing 6 months. They do have positive operating cash flow, even though they have a net loss. Operating cash flow of $62 million. The reason they have positive operating cash flow is because they pay so much in stock-based compensation, nearly $250 million. SBC is an expense that brings down your income, so it's on the income statement and it detracts from net income. But it's a non-cash item, so we add it back here. In the investing section, they had a cash inflow of $240 million. Most of that was from the purchase and sale of marketable securities. Only $1.6 million of PP&E. In their financing section, they added $171 million of capped calls. A convertible bond is pretty similar to a capped call. The only difference is it caps the amount of money the person can receive from converting their debt to equity. They also received $19 million from their employees purchasing stock. Let's look at a stock on Simply Wall Street. Its last price, $290, $26 billion market cap. Down 10% in the past week, down 26% in the past year. The stock has struggled. It looks like it IPO'd in 2017 at 31. It was getting close to 600 at the end of 2021. Hopefully you didn't buy it then, because it went from 570 down to 150. Then it ran up close to 500, but it hasn't gotten that high again, coming down to the low 200s. Now it's trading in the low 300s. Simply Wall Street's valuation is 167. They say the stock is 74% overvalued. 30 analysts price this stock at 380. They say it's undervalued. Look how much their revenue has grown since 2016. It was $65 million, and then it hit $1 billion in 2022. Now it's getting close to $2 billion. It's $1.8 billion in the trailing 12 months. Here's their debt since 2017. They had no debt. They started adding debt in 2018. Its peak was $1.2 billion in 2021. Now it's down to $1.1 billion. And their equity is a little higher than their debt. Debt to equity ratio of 84%. At one point they had negative equity, which means their liabilities are higher than their assets. The CEO's salary is only $400,000. Total compensation, $15 million. Tenure as CEO, 10 years. And you don't like to see this, but only insider selling, no buying. 93% of the company is owned by institutions, 4% by the general public, and 3% by insiders. The biggest shareholder is Vanguard and BlackRock. You have Wellington at 4%, Franklin Resources at 2%, UBS, First Trust, JP Morgan, Invesco. And their employee count went up a lot. It was only 754 in 2017. Now it's 5,400. That's mainly through acquisitions. And the ticker trades on the Nasdaq, Deutsche Börse, London Stock Exchange, Mexican Bolsa, and Sao Paulo Bolsa. So if you want to learn how to build a discounted cash flow model, and I'll send you a free one, click on the video in the top right corner. Thanks for watching.